Good afternoon, and welcome to Columbia University and the School of International and Public Affairs. My name is Robert Lieberman, and I am the interim dean of the school. And it's a great pleasure to welcome you all here for this afternoon's lecture by Richard Fisher of the Federal Reserve Bank of Dallas. My job today is a very simple one. It's to first tell you a little bit about SIPA and what we do here, and then to introduce my colleague Merit Janow, who will introduce our guest. SIPA is, we like to think, the world's leading school of global public policy. We are committed to the idea that in order for the world to be able to address some of its most pressing policy challenges, from development and human rights to the governance of the international financial system, which, as you might have noticed, is in need of some attention over the last few years, that we need to train students to understand the world, both in terms of the basics of public policy analysis and management, and the ability to really clearly diagnose and develop the tools to address policy challenges, but also to understand that in the 21st century, in a rapidly globalizing world, that it's no longer sufficient to think about policy in a narrow national or locally focused way, and that in order to address these most pressing and urgent public policy challenges, we need to understand the global nature of public policy. And that's why we describe the school and what we do here in terms of global public policy. And nowhere in our curriculum and in our portfolio of things that we do here at the school is that attention both to the public policy side of the equation and to the global side. Nowhere is that more apparent than in the work that we do here at SIPA on international finance and economic policy, and no one on the SIPA faculty or in the SIPA community is more important to that endeavor than Merit Janow. Under Merit's guidance, our concentration, our student curricular concentration in international finance and economic policy prepares students to think critically and independently about the challenges facing the global financial and economic system, and to become skilled, globally aware, creative thinkers, actors, and policymakers in a rapidly changing world. I want to thank Governor Richard Fisher for taking the time to visit us here at SIPA and to share some of his wisdom and experience with us. I want to thank Merit for making the event possible through the International Finance and Economic Policy Speakers Series. I want to thank the whole IFEP team, Kathy Medeo, and our SIPA events team, Joanne Crawford and Jesse Gale, for all of their work making this possible. We usually have a great view from up here. It's a little gray and cloudy today, but I hope you appreciate the view of, if you squint really hard, you can see Wall Street down there. And it's really my pleasure to ask Merit to introduce Governor Fisher. For the past 16 years, Merit's been a stalwart member of the Columbia faculty here at SIPA and in the law school. She's an extraordinary expert in international trade and investment with amazing experience in Asia, in Japan, in China. Her career has spanned academia, the business world, and government service. For a number of years earlier, a decade or so ago, she served as a member of the appellate body of the World Trade Organization in Geneva. She's brought that experience as well as her deep knowledge of international finance and economic policy to the school, to our students, to our curriculum. And it's just been a pleasure working with her for a number of years. And so I'm delighted to ask Merit to come to the podium to introduce our guest today. Thanks, Merit.
Thank you very much, Dean Lieberman. It really is a great pleasure for me and an honor to welcome President Richard Fisher to SIPA today. to be our 2013 Distinguished Speaker in International Finance and Economic Policy. You have his detailed bio, so I'll be very brief. I've had the pleasure of knowing President Fisher for some years when he was an outstanding deputy U.S. trade representative negotiating bilateral trade and investment treaties, agreements with our trading partners in Asia and in Latin America. He's always been a very distinctive voice, a superb orator, a forceful and independent thinker, and yet famously respectful of other viewpoints. Traits that have been very evident in his current role as president of the Federal Reserve Bank of Dallas and a member of the Open Markets Committee, positions that he has held since 2005. I've also observed that as a Fed president, he has taken on a role of an educator, having created a Globalization Research Institute at the Dallas Fed, I think the only one of its kind, and sending out a humorous and thoughtful finance and economic policy summer reading list to as many followers that I've been a recipient of and indeed dip into as a result of his recommendations. Indeed, President Fisher has had a brilliant career that has spanned several periods of service in both public and private sectors. Equally fluent in Spanish and English, he attended the Naval War College, Harvard College, and Stanford. And I know you're a Harvard man, President Fisher, and on the board of governors of that great university. But I want you to know that you are speaking today to a graduate student body that is, in my view, the best of its kind in the country, comprised of students from around the world that are deeply trained in finance and economic policy, and many of whom are actually headed your way. So over the past 5 or 6 years, we've sent 170 students to central banks, ministries of finance and the economy, 64 into the Treasury and OMB, 30 into the Fed system, and I think we have over 60 in the New York Fed alone. So our plan today is to have President Fisher offer his remarks, followed by a question or two from our distinguished faculty, 2 of them, Professor Svejnar, who is the founding director of our Center for Global Economic Governance and a leading economist, and Professor Charles Calomiris, the Henry Kaufman Professor of Financial Institutions, and then we'll open it up for questions from other distinguished faculty and indeed our students. Thank you so much for being with us today. Please join me.
Wow. What a pleasure to be introduced by Merit. And I can tell you, because I had to build upon her work as Deputy Assistant USTR, particularly her work on China when Charlene Barshevsky and I, as Charlene's deputy, negotiated their accession to the World Trade Organization. So, and also unmentioned by the Dean, if memory serves, you're fluent in Japanese, which is very, very difficult. And I benefited from your work there, so it's a great pleasure. She has a prodigious brain and a great personality, and just paved the way for so many of us. And one thing about marriage, you can't say no. So I learned that as a negotiator. When she asked me to come, I knew the answer was yes. So I thank you for having me. You mentioned this is a distinguished lectureship. I think that overstates my standing or my capacity. I'm unworthy of being considered distinguished, I think, at anything, except for having helped raise 4 children whose talents far surpass my own, and who I'm embarrassed to say in this audience all went to Harvard. But I thank you for the hyperbolic honor that you've given me. Well, as Merit mentioned, we go back a long way, and yet my involvement with this university and with Morningside Heights goes back even further. After I graduated from Harvard in 1971, I needed money to pay for Oxford, which I subsequently went to. So I spent most of a year working as a busboy and a bartender and doing a number of odd jobs in Washington, D.C. Testimony to the immediate benefits of having a Harvard degree in economics. Starved as I was in those menial jobs for intellectual sustenance, as I waited to return to academia, I found comfort in reading about public policy, especially then in the essays of a new journal called The Public Interest. The public interest, by the way, was a brainchild of a man named Irving Kristol and Daniel Bell, and subsequently joined by Nathan Glaser. They were originally young Trotskyites who spent their evenings as students at the City College of New York, known as the Harvard of the proletariat, trying to understand, in their own words, quote, how the socialist ideal of political and economic justice had ended in Stalin's murderous tyranny, end of quote. And they later migrated to what would now be considered prototypical Roosevelt cum Lyndon Johnson liberalism, and then they evolved into what are known as neoconservatives. These three men were becoming iconic public intellectuals at the time, and the public interest was something of a personal journal of lessons they learned during their ideological transformation. They ran, Kristol and Bell at least, ran a series of evening seminars and workshops here on this campus and at CCNY, and at every opportunity I would take an afternoon off. I would jump on a bus to New York. I think it was $6 to come up here. Attend their evening talks. I would find some kindly student who would let me sleep in their dorm room and return by bus to Washington the next morning. All this is by way of saying that I have been coming to this great university for over 40 years. Almost as many years as the number of consecutive football games your team has lost. I was especially captivated by Irving Kristol. His book, called Two Cheers for Capitalism, praised capitalism because, in his own words, one, it works, is quite simple in a material sense, and two, quote, is congenial to a large measure of personal liberty, end of quote. Irving Kristol famously described himself as a liberal who had been mugged by reality. And in writing a loving homage to Kristol when he died, David Brooks of the New York Times summarized the basis for Kristol's epiphany in what I consider classical New Yorkese language. He said, and I quote from the New York Times article he wrote as an obituary, "The elemental Jewish commandment in the working class neighborhood where Kristol grew up was, don't be a schmuck." In Texas, we don't know what that means. "And don't fall for fantastical notions that have nothing to do with the way that people really are." Well, as a member of the team of earnest men and women who formed the Federal Open Market Committee of the Federal Reserve, of our central bank, I consider myself a central banker who's been mugged by the reality of having been an investor and a market operator. I'm constantly wary of fantastical notions that seem cogent in economic or monetary theory, but run counter to what I learned in the marketplace, or, in my opinion, and this is my opinion only, run the risk of departing from practice in the real economy, or possibly having nothing to do with the way people and businesses, those who actually operate our economy, really are. Now, today, I'm not going to talk in this formal speech about international affairs. I'm going to wait for the inquisition by these two great professors. But I want to talk about two present risks as I see them. One is the current program of quantitative easing, and the second is the effect of Dodd-Frank legislation aimed at preventing what is known as too big to fail. I'll try to do this in short order, and I will, as Merritt asked me to do, I will do it as provocatively as possible in order to give the two great professors plenty of ammo for our first questions. So first, with regard to monetary policy and quantitative easing. I've argued what I have called, and I've argued against what I have called Buzz Lightyear monetary policy. And what I mean by that is pledging to hold the Fed funds rate, the base rate that we control, at zero, seemingly to infinity and beyond, while purchasing longer-term Treasury securities at a pace of $45 billion a month, reinvesting principal payments on all agency debt and mortgage-backed securities known as MBS, and then purchasing MBS at a pace of $40 billion a month. That's our current policy. Indeed, other than our initial program to underpin a recovery in the housing market with our first tranche of purchases of mortgage-backed securities, I have personally opposed all the other large-scale asset purchases or quantitative easing programs that the majority of the committee have adopted. Why have I been so obstinate in my opposition to this well-intended program? Well, I think I fully understand its theoretical underpinnings, but I question its efficacy. Confined as we are at the Fed at the zero bound, the only means of adding monetary fuel to the economy has been to purchase Treasury and mortgage-backed securities. When we buy something, of course, we pay for it. We put money into the economy. That money, backed by an assurance by the FOMC that we will hold interest rates at zero and continue large-scale asset purchase for a prolonged period, should theoretically be put to use, A, by banks lending to consumers and to businesses that will expand employment, or B, by investors who, rediscounting valuations in the fixed income and equity markets, will drive those markets higher in price, creating a wealth effect. This wealth effect should lead to further consumption as well as greater employment by businesses whose balance sheets have been reconfigured and enriched by the cheapest leverage in American history and booming prices for their stock. All these actions, I need to remind you, are in keeping with the dual mandate that the Congress of the United States has given the Federal Reserve. It calls for us to operate independently, both to maintain price stability and conduct policy in a way that engenders full employment. Given that inflation and, importantly, very importantly, inflationary expectations are presently contained, as we say, it would seem theoretically compelling to pursue the policy that we have undertaken. But a not-so-funny thing has happened on the way to the reality forum. While bankers and other sources of credit have slowly but consistently liberalized their lending practices, borrowers have not been especially keen to put cheap and superabundant credit to use in expanding payrolls to the degree that we would like to see at the Federal Open Market Committee. Now, to be sure, we have, as hoped, seen a reinvigorated housing market in the United States. Indeed, records of the FOMC, when they're eventually released, will show that based on the superb work done by two housing experts at the Dallas Fed, a man named John Duca, another named Anthony Murphy, working with John Mulbauer at Oxford University, Nuffield College, and thanks to our constant field soundings with housing and housing-related market operators, business leaders, the Dallas Fed was way ahead of others at the FOMC table, both in warning of the oncoming housing debacle and then recognizing the housing recovery. In fact, the fact that the housing market gears have now begun to mesh is why I believe we may be running the risk of overkill by continuing our mortgage-backed securities purchase program at the current pace, and I have suggested that we begin tapering those purchases. As to the more broadly impactful Treasury purchases, occurring as they have simultaneously with the loss of confidence in the Eurobond markets, I like to say, professors, that relatively speaking, the United States economy is the best-looking horse in the glue factory. Anyway, these two things occurring simultaneously have indeed led to a massive bond and stock market rally. The 9th time in U.S. history, we've experiencing a doubling of the indexes of the markets, stock markets, and corporate borrowing rates are the lowest on record in the history of the Republic, including those for CCC rated credits that are just north of default. That's the good news. Some sharp market operators have done very well. Private equity firms, for example. For them, hyper-accommodative monetary policy has offered a chance to go back to the glories of payment in kind or PIK financing and other financial techniques that enrich the financiers but may not create employment. For the largest banks and financial institutions, policy has helped them dig themselves out of the holes in which they found themselves, including, if you read the New York Times this morning, the hole of executive compensation. And for the wealthiest investors, even unto the Oracle of Omaha, there has been the windfall of superabundant credit that, after adjusting for tax deductions on interest and a modicum of inflation, is basically practically free. Ordinary savers and retirees have benefited from the turnaround in the all-important housing sector, but with the remainder of their savings, they've been waylaid on the sidelines of the zero bound. In addition, the 5,500 or so smaller banks that are the backbone of our communities in this country have seen their interest margins squeezed severely. The wealth effect, in other words, has been unbalanced. I would posit that Main Street does not seem to have impacted or been impacted to the same degree as Wall Street. Now, to be sure, as mentioned, business has been able to improve their balance sheets. They are enjoying higher stock market valuations of their businesses. However, thus far, businesses have pursued payroll expanding job creation with less enthusiasm than had been hoped for. Unemployment remains annoyingly high. There are some pockets of exception, if you'll forgive me for saying this, like Texas, which now operates at employment levels over 3% above its pre-recession peak. And over the last decade, by the way, has created jobs across the entire income spectrum in all 4 income quartiles. Whereas nationwide, job creation has been weak, and very importantly, the middle income quartiles have actually been shrinking. Employers large and small, privately owned or publicly traded, will tell you that despite access to cheap and abundant capital, they're hesitant to make long-term commitments, including hiring, most importantly, hiring significant numbers of permanent workers. They cite uncertain growth prospects for the goods and services they sell here at home, where consumption is retarded by slow growth in employment, and lately by the increase in the payroll taxes. And abroad, these employers point to the dampened consumption stemming from the economic debacle in Europe and its knock-on effects on China and the export-led emerging economies. They're uncertain about fiscal policy, not knowing what their taxes will be and what will happen to the all-important federal spending that directly impacts them or their customers. And they're uncertain as to the ultimate effect of their structures, cost structures, of the seemingly endless expansion of health care and other mandates and regulations, however meritorious their intentions. And for some, there is a deeply embedded worry that our central bank, the Fed's contortion of the yield curve and cost of money, cannot last forever, or if it lasts too long, will eventually result in financial bubbles and or uncontrollable inflation, adding another uncertainty to the plethora of uncertain factors that already plague them. As I walked down memory lane in preparation for this lecture today, I thought of my days at business school in the 1970s. Everything we learned in business school in those days was oriented towards operating and growing economies, or companies rather, under the assumption of constrained conservative debt markets and a fundamentals-driven equity market. Today, the opposite obtains. Credit is superabundant, and stock market behavior is conditioned not so much by the fundamental performance of its underlying companies, but by increasing doses of what I call monetary Ritalin. Against this backdrop, I'm not surprised by the reaction of business. Operating in a highly uncertain environment, it's eminently sensible for them to defensively use their newly strengthened balance sheets to buy back shares and to pay out dividends, or on the offensive side, to employ their balance sheets, say, in making acquisitions. Those acquisitions, by the way, often lead to employee rationalization and not payroll expansion for U.S. workers. This is how businesses really think. This is how people really are. The bottom line is that to achieve the intended theoretical effect, I believe, rather than achieving that effect, the policy of superabundant money at costs deviating substantially from normal equilibrium levels may prove ultimately to be counterproductive, or at a minimum it may restrain the benefits that theory would suggest. If this is so, should we continue the current program of quantitative easing? Well, I've argued that we should not, that we are pushing on a string, but I want to qualify this. I was indeed against escalating rounds of QE, quantitative easing, questioning their efficacy. But now that we have them in place, that they were adopted, as you know, we operate as a majority of the voters, and that's what the committee decided. Now that we have them in place, and the fixed income and stock markets are hooked on monetary Ritalin that we have dispensed in ever larger doses, it would, in my opinion, do great harm to force a sudden withdrawal. So I have argued that it would be best to taper the doses of quantitative easing so that the markets can adjust gradually to the eventual removal of this treatment and return to pricing securities on the basis of fundamentals. Am I right or am I wrong? I'm going to pose this question to the two professors and to lead the discussion that follows this lecture. Let me add one thought for the good professors to contemplate and for you all to contemplate before moving on to the topic of too big to fail. Now, this is admittedly out of left, I guess in memory to Irving Kristol, I should say right field. Having posited that thus far the wealth effect phenomenon has been concentrated in both the housing sector, a Main Street benefit and a powerful one, and in the hands of the savviest operators, those most able to exploit free and abundant money, primarily a smaller base consisting of the big banks and the investment community on Wall Street, and given that the private sector job creators are in a defensive crouch, and the federal government is likely to remain in a cost containment mode, might there be a way for others charged with fiduciary responsibility to the broader public to capitalize on the current moment? This is the extreme opposite of international policy. For example, Texas, with its highly rated government credit, has navigated its 27 million people through the Great Recession with strong fiscal fundamentals and a dynamic economy that has persistently outperformed the United States, and indeed all the other large states for at least the past 2 decades. Might it make sense for Texas to issue ultra-long bonds at currently prevailing ultra-low rates to finance the state's longer-term infrastructure needs? I have in mind a Texas Century bond. The public benefit would come from saving on interest payments that will inevitably rise over time from their unprecedented low current levels. Certainly, I think this is safe to say, they will rise sometime in the next 100 years. Meanwhile, using the proceeds to finance highways and water projects and universities and the like that will be needed to continue serving the state's growing population and expanding economy. If ever there was a window for such an issuance, it surely must be now. Domestic entities seeking to match longer-term liabilities and commitments, as well as sovereign investors like the Norwegians and others, are keen on finding so-called risk-free dollar-denominated assets of long duration. And you should note that Mexico and private universities such as MIT have already placed century bonds earlier in this cycle. Because the U.S. government cannot capitalize on such demand and is stuck in a rut of issuing short-term dated debt so as not to add to its deficit, question, could or should other dollar-based, and I use sovereign issuers, like the best credit rated states, especially a very large one like Texas, should they do so? I just throw that out for your contemplation. And now on to too big to fail. Everyone and their sister knows that financial institutions deemed too big to fail were at the epicenter of the 2007-2009 financial crisis. Previously thought of as islands of safety in a sea of risk, they became enablers of a financial tsunami. Now that the storm has subsided, my colleagues at the Dallas Fed and I submit that they are another key reason accommodative monetary policy and government policies have failed to adequately spur the economic recovery in the United States. Our research director, Harvey Rosenblum, and I first wrote about this in an article we published in the Wall Street Journal in September of 2009 titled "The Blob That Ate Monetary Policy." Put simply, we argued that sick banks do not lend. Sick or seriously undercapitalized mega banks, whether they're here or abroad or elsewhere, including in the Czech Republic, severely constrict their usual lending and capital market activities during a crisis and even unto an economic recovery. They brought economic growth to a standstill and spread the sickness to the rest of the banking system. So Congress thought it would address the issue of too big to fail through the Dodd-Frank Wall Street Reform and Consumer Protection Act. Preventing too big to fail from ever occurring again is in the very preamble of the act. It is its purpose. And we contend at the Dallas Fed that Dodd-Frank has not done enough to corral too big to fail banks, and that on balance, the act actually makes things worse and not better. We submit that in the short run, parts of Dodd-Frank have exacerbated the weakness in economic growth by increasing regulatory uncertainty in key sectors of the U.S. economy. Despite its good intention, it has been counterproductive, working against solving the core problems it seeks to address. Let me define first what we mean by too big to fail. The Dallas Fed's definition is financial firms whose owners, managers, creditors, shareholders, and customers believe them to be exempt from the process of bankruptcy and creative destruction. Such firms capture the financial upside of their actions, but largely avoid payment in terms of bankruptcy and closure for actions gone wrong. This is in violation of one of the basic tenets of market capitalism, at least as it's supposed to be practiced in the United States. They're thus more likely to take greater risks in search of profit, protected by the presumption that bankruptcy is a highly unlikely outcome. The phenomenon of too big to fail is the result of an implicit but widely taken for granted government-sanctioned policy of coming to the aid of a financial institution deemed to be so large or so interconnected and or complex that its failure could substantially damage the global financial system. By reducing a too big to fail firm's size or exposure to losses from excessive risk-taking, such policies undermine the discipline that market forces normally assert on management decision-making. The reduction of market discipline has been further eroded by the implicit extensions of a federal safety net beyond commercial banks to their non-bank affiliates. Moreover, industry consolidation fostered by subsidized growth and during the crisis, encouraged by the federal government, the acquisitions of Merrill Lynch and Bear Stearns, Washington Mutual, Wachovia, has perpetuated and enlarged the weight of financial firms deemed too big to fail. This reduces competition. Dodd-Frank does not do enough to constrain the behemoth banks' advantages. Indeed, given the economies of scale in handling regulation, we would argue that Dodd-Frank's excessive complexity to undermine its competitiveness of smaller banks thereby offsets some of the Act's other aspects that curtail too big to fail banks' dominance. It unwittingly exacerbates the problem it set out to solve. Andrew Haldane, the highly respected the Financial Policy Committee of the Bank of England, addressed this at last summer's Jackson Hole, Wyoming policymakers meeting in witty remarks which he titled "The Dog and the Frisbee." I highly recommend that speech to you. In it, Haldane noted Dodd-Frank comes against a background of ever greater escalation of financial regulation. He pointed out that nationally chartered banks began to file the antecedents of what we call call reports in the business after the formation of the controller of the currency in the year 1863. The Federal Reserve Act of 1913, which created our system, required state chartered member banks to do the same, having them submitted to the Federal Reserve starting in the year 1917. There were very short forms. In 1930, Haldane noted these reports numbered 80 entries. In 1986, the call report submitted by bank holding companies covered 547 columns in Excel. By 1999, 1,208 columns. By 2011, 2,271 columns. Fortunately, Haldane noted, Excel has expanded sufficiently to capture the increase. Though this increasingly complex reporting failed to prevent detection of the seeds of the debacle of 2007-2009, Dodd-Frank has layered on copious amounts of new complexity. It has 16 titles. It runs 848 pages. It spawns litter upon litter, to keep with the dog analogy, of regulations. More than 8,800 pages of regulations have already been proposed, and we are not done. In his speech, Haldane noted, conservatively in my view, that a survey of the Federal Register shows that complying with these new rules will require 2,260,631 labor hours each year. He added, and I quote, "Of course, the cost of this regulatory edifice would be considered small if they delivered even modest improvements to regulators' ability to avert future crises." But he then went on to argue that the wick is not worth the candle, before concluding, and I quote, and this is a good quote, "Modern finance is complex, perhaps too complex. Regulation of modern finance is complex, almost certainly too complex. That configuration spells trouble. You do not fight fire with fire, and you do not fight complexity with complexity. The situation requires a regulatory response grounded in simplicity, not complexity." This case for more effectively treating too big to fail is especially compelling, given the subsidy these institutions now enjoy by virtue of their protective status. The too big to fail subsidy is quite large. It, in fact, has risen since the financial crisis. Recent estimates by the Bank for International Settlements, for example, suggest the implicit government guarantee provides the largest U.S. bank holding companies with an average credit rating uplift of more than 2 notches, thereby lowering average funding costs a full percentage point relative to their smaller competitors. And my aforementioned friend, Andy Haldane, estimated in 2011 that the implicit too big to fail global subsidy is roughly $300 billion per year for the 29 institutions identified by the Financial Stability Board in 2011 as, quote, systemically important. To put that $300 billion estimated annual subsidy in perspective, all the U.S. bank holding companies, total together, reported total earnings in 2011 of $108 billion. So Harvey Rosenblum and I and our team at the Dallas Fed have proposed a simple amendment to Dodd-Frank. We want to remedy the too big to fail pathology. We would eliminate what I call the mumbo-jumbo, ineffective, costly complexity of the law, relieve the regulatory imposition it imposes on non-too big to fail banks that do not pose systemic risk or broad risk to the economy or the financial system, and eliminate the unfair subsidies that too big to fail holding companies enjoy at the expense of smaller competitors. Our proposal is to level the playing field for all banking organizations to provide better protection for U.S. taxpaying citizens. I laid out this proposal the speech in Washington, D.C. on January 16th. I would humbly suggest to the students and professors in this room that they access it and study its details. In a nutshell, we recommend that within a complex bank holding company, only the commercial banking operations that intermediate short-term deposits into long-term loans, that's what banks do, would benefit from federal deposit insurance and access to the Federal Reserve's discount window. All other operations of a complex bank holding company and all its so-called shadow banking affiliates would not have this protection, would not have access to the discount window. To reinforce that understanding that taxpayers will not come to the aid of risk taken by those entities, every customer, every creditor, every counterparty of every shadow banking affiliate and of the senior bank holding company would be required to sign a new covenant, as I call it. It's a simple disclosure. Actually, we had drafted by a 6th grader. And it reads like this. Conducting business with this affiliate of XYZ Bank holding company carries no federal deposit insurance or other government protection or guarantees. The counterparty, we had to give them the word counterparty, herein fully understands that in conducting business with XYZ's banking affiliate, it has no government protection or guarantees, and this investment is totally at risk, end of quote. Now, unfortunately, established customer relationships are very slow to change. To accelerate the transition to a more competitive financial system, our proposal has a 3rd element to help level the playing field. Specifically, we recommend that the largest financial institutions be restructured so that every one of their corporate entities is subject to a speedy bankruptcy process. In the case of the banking entities, that each be basically of a size that is too small to save. This would underscore to customers and to creditors that a credible regime shift has taken place and the reign of too big to fail policies is over. To circle back to Irving Kristol and to conclude, I believe that this suggested remedy we've put forward to the pathology of too big to fail works, to quote him, in a quite simple material sense, and is, to quote him again, congenial to a large measure of personal liberty. It most certainly dispenses with the fantastical notions of the way people are. Now, Merritt, I've thrown a lot into this speech, very domestically focused, very current policy focused. I thank you for tolerating me, and now in the very best tradition of central banking, I will do my best to avoid answering your questions. Thank you very much.
Thank you very much. Thank you very much.
So, what's the drill? The professors get the first shot.
Well, we're going to have a dialogue.
Okay.
And we're not going to talk to you about currency, so you'll have to answer the questions.
Okay.
Let me invite Charles.
You can't say no to Merritt.
Pardon me?
Can't say no to Merritt. Go ahead.
Start with Charles Calomiris.
Thanks for a great speech. If you were familiar with all of my writings, you'd know that the main challenge I'm facing right now is to figure out what to say to disagree with most of what you've said, because I actually am very congenial with your point of view on both the QE issues.
That's why we picked you.
Yeah, I guess that's the puzzle. But I'll plan that I'll get 2 questions eventually. So I'll because it's hard to choose which one I would ask you. So, and the tough part also is figuring out a question, as you pointed out, that you're going to answer. So let me start with the QE part and ask the first question about that. So, first of all, I think it's pretty clear we're already in a bubble land in farmland in the U.S., in corporate bonds, junk bonds, and in commercial real estate. So I don't think there's much question there. And on the international dimension, we're already seeing the sort of search for yield propelling capital flows massively into emerging markets that are putting pressure on those currencies and creating pressure for capital controls and other sorts of devices. So, but I think the horse is already out of the barn in terms of we're going to be experiencing a bubble. What I'm worried about, and I'll answer your question too. Yes, you should be buying, you should be selling long-term debt, and you should advise the U.S. Treasury that this is a crazy time to be bringing in new kinds of floating rate debt. This is exactly the time to be locking in these unprecedented low long-term rates. I agree with you. I'm worried about the next act of the play. And the 2 worries that most of us have been talking about with the Fed have to do with how fast the Fed is going to be able to react in its balance sheet to actually try to prevent the enormous inflation that could potentially happen. And the problem with your answering this question is it's about politics. So there are two political constraints that people have been talking about. Alan Meltzer has argued that even a couple percentage point increase in interest rates on government in the economy will have a massive effect on the government deficit because so much of government debt is short term right now.
Yep.
Getting back to the need to go longer term. So his estimate is a couple percentage point increase over a couple of years will add $140 billion to the annual deficit just from the debt service consequences of it alone. And he's concerned that the Fed will be unwilling, largely because of congressional pressure, to move very quickly to create, in this environment, those kinds of fiscal consequences. So that's what can you say to help us understand why the Fed won't be subject to the Meltzer political problem? The second one is one that I've been arguing for some time, another political problem. And that has to do with the Fed's financial insolvency risk. So the Fed, of course, has huge long-term debt and mortgage-backed securities. If interest rates start to rise as part of a monetary policy, that's going to make the Fed potentially insolvent on a financial accounting basis. Of course, that has no effect on the Fed's ability to contract the money supply, but it might have a big effect on the political consequences for the Fed in Washington, as now not providing any revenue to the Treasury through its lack of any profit, but then also being massively insolvent. So how do you think about, if you can find a way to answer this first question, these two political risks that both are pushing very hard against the Fed being able to contract when that becomes necessary? What can you share with us in your thinking about that?
All right. Interesting statement posed as a question. I'll try to answer. But again, you and I are blood brothers in the way we think of many issues. On the second issue, the chairman addressed some of that in his congressional testimony, and we have done sensitivity analyses. We have made a lot of money for the taxpayer recently. The numbers have been quite huge, over $200 billion the last 3 years. The reason for this, just to make this very simple, is we've lengthened our portfolio. We don't hold any short-term paper at all, which is extraordinary for a central bank. And we've moved out the yield curve. This is part of our Operation Twist, named after the program put together in 1963 under President Kennedy. By the way, by my mentor, Robert Rosa. It didn't work in 1963, but anyway, we have been extending our exposure. We now have a total balance sheet that exceeds $3 trillion. When we started the crisis, we were at $800 billion. So this is the context in which the question by Charles has been asked. And I think the chairman has adequately answered that, which is it may be that we do not remit to the Treasury what we have been remitting. Let me just say, you're looking at one of the few individuals of 19, a group of 19, that has actually done something rather unusual. We pay down the deficit. And we do it without a direct penny of government support. So we've made a lot of money for the taxpayer. That's odd. Question that you've asked, the second question, is can we continue to do so, and what happens if rates rise? Well, obviously you have the coupon coverage, but then the question is how much erodes principal. The way we would book that, and you'll love this terminology, but it's a deferred asset. So we just defer something we would pay to the Treasury. And the logical order would be you'd have a reduction in the payments that we have been making, over 70 some odd billion recently, this last year. And the issue is whether or not you actually would have a negative return and have to call capital from your member banks. We have the right to do so. I think given the analysis we've done, that's a highly unlikely circumstance. You'd have to have rates rise to awfully high levels that I think from its current level are not really imaginable at the current level. Clearly at some point, if rates went to 14, 15, I don't know what the number is, but you might be faced with that constraint. The real issue is, does Congress have any memory, right? Some would argue that they had the memory of fish. And there was a Congressman Fish, by the way, he's very famous from New York. But it's a short-term memory. And will they remember that two things, as the chairman pointed out. One, we have remitted a great deal. We're the only people that helped pay down the deficit. in large numbers, not sufficient numbers. And then secondly, that this would come at the benefit of hopefully an expanding economy that would drive rates up. And let me comment on that. Rates would go up for one of two reasons. One is the economy improves, more demand for capital, supply demand gets equilibrated, and rates increase from their currently impossibly low levels, difficult low levels. The other would be the bad outcome, which is inflationary expectations shift, to get to another part of your question, and the market begins to discount an inevitable inflationary consequence of having all this money sit on the side. We have over $1.6 trillion in excess bank reserves. We pay 25 basis points to these bankers who leave it on our balance sheet. No banker wants to earn 25 100ths of 1%. They'd rather lend it at 4 or 6 or whatever it may be. And we have, of course, extraordinary amounts on corporate balance sheets, and in non-depository financial institutions, about $3 trillion total. There's a lot of excess money sitting on the sidelines. Question, what happens when it comes back in? And that gets to how we treat this and how we withdraw. And your first question was, what about the politics of that? Well, my own view, and again, this is me personally speaking, everything I say is my own view, by the way. I don't speak for the committee. Only the chairman can speak for the majority of the committee. My own view is that we should be oblivious to politics. And we should just do what's right. We have a franchise. If they want to take away our mandate, they have a right to do so. So I said in my speech, they've given us a dual mandate, and we operate independently under that dual mandate. The root of this issue, in my personal view, is the employment mandate. I disagree with it. I would rather have a single mandate. I'm on record for saying that. Because it begins to dovetail more with fiscal policy. We know, and you should know as students, that inflation is a monetary phenomenon. And whether you were originally a supporter of Milton Friedman or not, I think that's been convincingly proven over time. In a globalization context, it's a little bit more difficult to get the direct linkages, but we've had so much money printed by all the central banks around the world. There's been such accommodative policy. This, I think, really is the issue that I would concern myself most with long term. We don't see it now in expectations as we measure them by the futures market or by surveys, even though there's been a slight creeping up. But right now, it is fair to say that inflation and inflationary expectations are contained. But that is a monetary phenomenon. It's not clear that monetary policy is sufficient to deal with the unemployment mandate. And I was against the 6.5% mark that we put in a couple of meetings ago, because it's, I would say, necessary but not sufficient. Let me give you an extreme example. Let's say a government, in this case the United States government, decides to tax 100% of all income. All the monetary accommodation in the world is not going to spur the economy. So it really is an issue of how they view our responsibility. I agree with Chairman Bernanke, and not because he's chairman. We often have disagreements. But I agree with him in the sense that it needs to be remembered that we were given this mandate by Congress, that we have to operate it under the law. And as long as we have it, our job is to make sure that we maintain price stability, at the same time that we create the conditions as much as possible for full employment. And again, this is what we've been assigned to do. Now, you know, politics is a very fickle thing. And whether or not they remember they gave us this assignment in the first place, it is a natural instinct of a politician, whether you're a politician in Brazil or you're a politician in Europe or anywhere else in Asia, point your fingers at somebody else. And this is a risk that we run. I agree with you, Professor. It's a risk we're just going to have to manage.
Thank you very much. We invite Jan Svejnar.
All right. Well, let me
This is a
also-
very famous man. They're both famous guys, but this guy's really a famous guy. Go ahead, Jan.
No. So, well, again, an impressive lecture, and I also tend to agree with a lot of what you say. So I'll try to leverage some opposite views here in order to create discussion. By the way, since you're so closely affiliated with us, this is basically an intramural discussion, and you have to answer the questions. So let's look at the too big to fail. So I imagine the sort of obvious counter-argument here is the question is, are there economies of scale, right? So is there some really good benefit to have large institutions, large banks, and should we therefore not focus on what the banks are doing that's dangerous and bad rather than the size? Is size really the one variable to focus on, or could you actually accomplish what you want by focusing on complexity or whatever, something else, and let all of us enjoy the economies of scale to the extent that they are there, plus the multifunctionality and international reach and all these kinds of things, right? So that would be good if you can maybe elaborate a little bit on that, and how should we in a way think about it. A tantalizing kind of extension of that is with the sovereign debt, are there countries that are too big to fail? And what can we do about that using your
You're talking about Texas.
wisdom? No. Just exactly. So, Argentina has had a hard time returning to the markets, and Russia returned very quickly. So obviously, there are different treatments for different size countries, different types of countries. Question is, is that. Now, the other part of your too big to fail is also intriguing, and that's the Dodd-Frank. And I agree with you that if it's a too complicated, too time-consuming an exercise as a result of such a law, then obviously it's counterproductive, right? Now, as I recall the Haldane article of the Frisbee and the dog parable, he is saying, well, the dog runs and can catch the Frisbee, but when you kind of look at it, it's a really very complex movement. And how does the dog, with its brain, manage to figure out all that and catch the Frisbee? And the simplification, as I recall, is that the dog runs next to the Frisbee. And if you move at the same speed, it's very simple. And then the dog grabs it. So how can the regulators run at the same speed and grab the Frisbee in your argument? And I agree it would be much better. So enlighten us how you're going to do it.
Well, with regard to size, there's a question of, there's economies of scale, but there's also a challenge to scope.
Scope, yeah.
What's manageable, what's not manageable. Again, we have some of those, particularly here in New York, we have some of those talented bankers, I think, ever. And yet you can see mistakes have been made. How do you build risk management systems? They're built by, and I'm sure there's some in the room, and I mean no disrespect, but brilliant quant jocks. But in the end, what banking is know your customer, know your risk. And you can mathematize a risk management model all you want. And yet you can have a boo-boo occur in London or someplace else that might put you in an awkward position. So I do think there are limits to complexity and to scope as well as to size. And we've been very careful. I've been quoted as saying 100 million. I never gave that number out. I can't remember at least doing so. And I do think the market will find a solution if you follow the prescription that we have suggested here. Some people are good at some things, they're not good at others, and I think you'd have more of a market-driven rationalization. I would prefer that kind of outcome, personally, after you have set the rules that I mentioned. I want to remind the audiences here that we had a period where the Japanese had the biggest banks in the world, and we lived in mortal fear. They're going to end up dominating everything. Well, it didn't work very well. I would also say that whether they or the Chinese or anybody else wishes to exploit their taxpayers or their citizens to take this underwriting risk, which I do not feel is appropriate for ours, that a good credit's going to find a banker. They'll find a creditor. The people who challenged Harvey Rosenblum's and my thesis the other day actually cleverly put a long op-ed in the Dallas Morning News, which is the most important paper in the world, arguing against our case, and they had a very interesting argument. They said if what Fisher Rosenblum, or we call it Fisher Bloom, has decided to do were to obtain, then Southwest Airlines and Texas Instruments would leave the United States. You know what's interesting about that argument? And I hope the press picks this up. My chairman of my board is the founding chairman of Southwest Airlines, Herb Kelleher. He thought that was ridiculously funny. And I spoke the other day to the CEO of Texas Instruments. He's a very good friend of mine. He said it was a ridiculous argument. TI or Southwest Airlines are going to find a creditor, and there'll be a willing lender. If those banks are subsidized by their taxpayers, let them be. I don't want that to happen here in the United States. With regard to countries, it depends on time and where you are. Argentina at one point is sort of a pariah, and other times it's welcomed by the marketplace. Right. And for the students here, I want to suggest, and I mean this with all respect, very little changes in human nature. You and I have been around, you've been around so long, and I've been around almost as long, but I would urge you to go back and read about the Mississippi bubble. We've seen all this before. It happens. And I have this little quote here that I like to go back to Bagehot, who wrote an essay in the National Review in 1856 about Edward Gibbon. At particular times, people have a great deal of money. At intervals, the money of these people is particularly large and craving. It seeks for someone to devour it. And there is a plethora. If find someone and there is speculation, it is devoured and there is panic. Nothing has changed. So why would we structure a system to encourage that? I'd rather structure a system to the best of our ability to discourage it. We know there will be markets, as Charles pointed out, that overshoot. There will be bubbles. We have to make sure we construct a system that limits the damage that can be done to the citizens, not just of our country, but elsewhere. And again, I've argued with all my heart that I think that the current too-big-to-fail system does not provide that protection. We know that people will make mistakes, no matter how much analysis is done. So the mood changes with regard to countries, and obviously we are the single most important country in the world. There's all this debate. If you look at the number of data transactions, or commercial transactions in the world, the dollar's on one side or other of 80% of all commercial transactions in the world. We are the dominant currency of the world, and we are the dominant central bank of the dominant economy of the world. I don't believe we're going to fail. And neither do I believe, Charles, that the central bank will become illiquid. Although I'll bear your thing in mind, because now you have me scared. I'm just kidding.
Thank you very much. With that, why don't we open it up for questions, and let me invite Professor Rich Clarda to lead us off. I think we have mics.
Well, President Fisher, that was really an excellent speech. I've had the privilege of hearing you before, but it was excellent. So, and the topic of my question is really communication. You obviously have a skill for communication, and many would argue, I would argue that the Fed is having some communication challenges now, in particular to communicating its views about the balance sheet and exiting from the balance sheet, and as well as the recent innovations by the Fed to publish the policy rate forecast. And for those who've seen those, they come out, there are 19 little dots on a page. So any thoughts that you could provide the audience, because I know it's an ongoing subject at the Fed based upon the public comments of Janet Yellen and others. So any comments that you could share with the audience about how the Fed could refine its communication for the existing policy, both in terms of the balance sheet and the path for the policy rate, would be appreciated. But again, thank you for those excellent remarks.
Well, I'm going to go back to my own father, who was uneducated and struggled to come up from just hyper-intensive poverty. But he had a great wit. And you have to put this in the context of his generation. He was born in 1904. But he told me, don't ever wink at a girl in the dark. Now, let me tell you what he meant. He meant you may have the best intention and the greatest idea, but if you cannot communicate it and it cannot be seen or understood, it is of no value. Remember that. Don't wink at a girl or a boy in the dark. So, this sounds very basic, but we live in a very complex world, and we perform a complex function. I think it's very important for all of us to remember as central bankers, we're not just speaking to 10 or 15 or 100 economists. We're speaking to the country. Very importantly, to get back to the point that was made earlier by Charles, we're also speaking to those that are in charge of the affairs of our country, and who, in the end, ultimately can change our franchise. Those that we elect to the Congress of the United States, both the upper and lower house, and in the executive branch. And this requires direct communication. I spend all of my time when I speak trying to, and I write my own speeches. I'll give you a little secret. I'll probably be heavily criticized for saying this. It takes 2 glasses of good Cabernet to write a good speech. If you have 3, it becomes sloppy. If you have 1, it just doesn't have enough stuff. And then my staff and everybody else has to spend hours and days fact-checking and going over the facts. But part of it's my background. I come from a business background. I'm not a PhD in economics. I'm proud of that. but there's a group, and it's a wonderful division of labor. People just have incredibly hyper-intensive brains. Ben Bernanke is an example. Professor Stein, who we were very lucky to get to come on the Open Market Committee from Harvard, is another example. And there are others that come from a regulatory background. The reference to farmland prices comes from the wonderful new president we have at the Federal Reserve Bank of Kansas City. Eric Rosengren in Boston comes from a regulatory background. I come from a business background. Dennis Lockhart comes from more of a business background, et cetera. Betsy Duke, a governor, was actually a banker. Imagine that, at a central bank. And I think our effort needs to be to communicate in a clear way where we can be understood more broadly. Now, this is very different than this discussion of transparency. Sidebar. A lot of the transparency discussion is driven by a belief in perfect markets. And I happen to believe that markets are not perfect. Having been a market operator, I've learned that sometime at great cost in my previous careers. So, but the idea is the more information you put out there, the better the market will be able to discount and understand the decisions that you make, and the expectations will fall better in line, and so that, to use your dog and a frisbee analysis, they'll run more parallel with policy and where policy wants to go. I'm not so sure about that. I think you can confuse people. Those little dots, by the way, I argued against that. And so then one of the reactions might be, well, let's put the names with those little dots. My argument is fine, go ahead, because no one can forecast easily. And somebody at this table, it may be me or somebody else, will be embarrassed eventually by what their forecast might have been, because we know that we're not very good at it. We do the best we can. This is a judgmental game. It's a long way of saying that mathematizing what we do may not be the best way to communicate, either because the audience is much larger, particularly now that we have been excoriated by the political forces and continue to be. So we have to communicate in a way that people understand. And then secondly, because we can also misguide by providing an artificial sense of mathematical precision to something that is not mathematical. In the end, this is a judgmental issue. Banking is you can, again, build risk management models and should always think of decision trees in probabilistic terms. But in the end, it's a judgment. Is this a good credit or not a good credit? And you cannot mathematize that away. We cannot mathematize our way into communicating effectively. And I fear that unfortunately we're tending in that direction. But again, that's my background, and others have a different perspective. We're trying to communicate as much as possible without miscommunicating. And it's driven, again, by efficient market theory, in my view. And I'm not a believer in efficient markets. I quoted the Oracle of Omaha. It wouldn't be possible if there were efficient markets. So Fisher Black used to say that when he was on the banks of the Charles River up in Massachusetts, he believed in efficient markets, but he learned differently when he came to see the banks of the Hudson. So that may be the underlying still hypothesis that markets are efficient. I've been disabused of that notion by virtue of practice. So take away from this entire speech, don't wink at someone in the dark, okay?
Thank you very much. Question over here, Professor Gordon.
Hi, I'm Jeff Gordon. I teach at the law school. It's hard to resist the idea that we should avoid the too big to fail bank. The question is how to get from here to there, of course. And so a couple points of your analysis to me seem to me not to ring true. There, Stearns was not that large a financial institution, nor was Lehman Brothers for that matter, but because of the role they played in the financial system, the cost of non-intervening was very high. The notion that you have suggested that we could, in effect, produce in the United States the Vickers proposal in the UK, which is to say the central commercial bank surrounded by the ring-fenced non-bank affiliates, I mean, it seems to me it doesn't pay sufficient attention to the fact that if a significant fraction, an increasing fraction of credit intermediation is done outside of the core central, the core interior bank, then the notion that you can decide to, in effect, let the ring-fenced non-bank go without severe damage to the real economy because you're pursuing it of letting that bank fail, it seems to me that that, you know, doesn't pay attention to where the real credit intermediation is occurring. Yes, you may avoid extending the safety net to the non-bank bank, but on the other hand, the costs at a time of unpredictable systemic distress can be very high. And it seems to me that the real intellectual challenge of Dodd-Frank is to figure out what to do with that part of the credit intermediation system outside the bank. And its success perhaps will be judged not just by Title II, the resolution authority incentives to avoid failure, but also what it does to the oversight of the place where an increasing share of credit intermediation is done in the real economy. Question mark.
I'm glad you ended with a question mark. No, those are very, very good points. And I'm not calling for the removal of complex bank holding company structures. What I am saying is, what is the limit in terms of access to the discount window and taxpayer exposure? And how do we limit that exposure? And we have suggested it be limited to the basic credit intermediation function of commercial banking. That doesn't mean the rest of it can take place. It doesn't mean that you would have to break up the bank holding companies. It does mean, however, that they would be subject to market disciplines, and that they would not operate under the assumption that they would be bailed out if they err. You mentioned Bear Stearns and Lehman. You're right. Although, as the transcripts recently revealed, there was quite a discussion at the table about that. The then head of the New York Fed was a man named Timothy Geithner, who kept assuring us that it wouldn't have much impact, and I was arguing that it was much bigger than we expected. Why? Because the banks were what Haldane would call, and I call, spreaders, think in a virus sense. And they were spreading this disease through the system because they were accomplices to the structures that had been created by, underwritten, and distributed by Bear Stearns and Lehman. Now, you're a lawyer. I'm not a lawyer. And most members of our political structure, our Congress, are lawyers. I do submit that the amount of credit intermediation that's done outside the pure commercial banking system is extensive. In fact, it's about 60% or whatever the number may be. It's a majority. Even if that is so, I think we have to figure out a way to protect the ultimate liability of the taxpayer. Because if you carried your logic, and I mean this respectfully, and I'm sure your ability to process logic is better than mine, but if you carry it to an absurd extent, to absurdum, why not end up with one large bank holding company? And what happens if that fails? Or if you have failure, might you not end up under the procedure we now have under what's called the FSOC, Financial Stability Oversight Committee, chaired by a politician, the Secretary of the Treasury. It's a political appointee, not a central banker. Might not there end up being, instead of, say, 5 or 6 mega too big to fail institutions, 3 or 2 or 1? Where do you stop? How do you constrain this? Our proposal is aimed at constraining that impulse. We will have another financial crisis. And for the students here, it'll happen in your lifetime. It may happen again in my lifetime. The question is, what then happens with further consolidation in the financial structure? And is it the proper and competitive way to go, and does it lead to the most efficient outcome? But I think your points are very, very good, and they need to be debated against the proposal that we have suggested. I just worry that, again, if that logic is accepted, then we never get out of this trap. And we end up with a small handful of mega institutions that then, if they are put at risk because they cannot be managed to the scale and scope in which they've been constructed, get into trouble. But we have to put an end to this. And I believe our proposal is, going back to the crystal principle, is the most simple proposal, most straightforward proposal that I've yet heard crafted, although I would welcome others as well.
Thank you. Let's have a
That's a good
student.
example of avoiding
Let-
answering the question.
Let's have a student or two. Okay, let's collect 3 student questions, if you don't mind. I know
Sure.
you have some time.
You may have to remember them for me.
Pardon me?
Go ahead.
Please.
Hi, thanks so much for coming. I thought it was a really great speech. So in a dual mandate context, I'm wondering if, in your view, simply tapering off QE is the optimal policy, or if there are some stimulative measures that could be combined with that to supplement it.
Okay, next question.
I think we're
No, I'm gonna answer all
We're
of them.
collecting a couple, so I think I saw in the back.
Good afternoon. I would like to follow the line of Professor Clarida's question. The current program of quantitative easing QE3 is fundamentally different from the previous ones. First, because it is open-ended, an open-ended program, and second, because it uses a different kind of forward guidance to communicate to the markets, conditioning the end of QE3 on an improvement in the labor market or an unfavorable cost-benefit trade-off. Now, I understand you're not very enthusiastic about quantitative easing, but I would like to ask you, what do you think are the pros and the cons of these innovations in balance sheet policy?
Okay.
One last, there's more than a few. This lady here.
I have a question about what you mentioned about Bear being a spreader,
No, the banks were the spreaders.
the banks being a spreader. If you say that making institutions smaller is better than allowing the big institutions, how does that policy stop spreading between those institutions, particularly if those institutions are acting in unison?
Could we get one more question for you? If we have a student? Yes, over there, please.
Going back to the too big to fail question, there's been some prescriptions, like the concept of a bail-in capital structure proposed as a potential alternative to breaking up the banks. So I wondered if you could just speak about your thoughts on that.
All right. So we have 2 basically on too big to fail. The other is with regard to monetary policy. Let me address the monetary policy. The first question was with regard to our dual mandate and tapering, and what could, say, offset since we have a mandate on employment. And then the other question was with regard to the second question, the pros and cons of what you referred to as an innovative technique of using our balance sheet. I think I am correct in stating that the efficacy of what we've done to achieve higher employment has not been perfect. And even as I said in my speech, it is combined with forward guidance. We're talking about holding the Fed funds rate at 0, and we originally were using a date. And we had enough argument about that, and we came around to the 6.5% number for employment. I would say yes, there are some supplements, as you put it, stimulation. And that would be a fiscal policy that is understandable and can be planned around. The greatest enemy of decision making is uncertainty. If there's massive uncertainty, you go into a defensive crouch. And we have enormous uncertainty. I mentioned them in my speech. Uncertainty about final demand both here and abroad, always a driver of how you build your firm to achieve the top line as well as bottom line of profitability for your shareholders or whoever may own the company, public or private. The problem I have right now with this whole issue of uncertainty, first, it's total uncertainty. No one knows what their taxes are going to be. No one knows federal spending against me. And there is a growth in the Federal Register in terms of regulation and mandates. I think the real problem is, and this gets mainly to what you teach here, is that we don't think in a globalized context. We still have what is essentially, in my view, a fiscal policy that is driven by layer upon layer upon layer of lobbying that has accumulated during the Cold War period, and we don't live in that world anymore. We would have much more effective gear meshing of monetary policy if we could incent businesses to put that capital to work, helping us meet our mandate of employing more people. And the one thing I do not hear from members of Congress is how do we structure our fiscal policy to be the leader in a post-globalized world, post-Cold War world? We won. We won the Cold War. It's an incredible achievement. My entire generation, starting in elementary school, we used to go into bomb shelters, to when the wall came down. Blood and treasure was spent and spilt in a Cold War. Once that was done, new forces were liberated. We used to have a G6. I was President Carter's assistant at those meetings. Now we have a G Googleplex, right? There's so many G's you can't count them anymore, so many meetings. Because China, India, Brazil has gotten, everybody's entered the system. And they are competitors for capital. And by the way, any company, by shareholder rule and law, works to achieve the maximum return on equity and the maximum return on investment. They are free to roam. We wanted this system. Merritt and I spent an enormous amount of time trying to negotiate free trade agreements. We wanted this system. And now they don't have to play here, nor are they obligated. In fact, they are obligated to do whatever is the most efficient thing. That's the way capitalism works. So I would like to see a fiscal policy that would incent businesses to take advantage of the cheap and abundant high-octane fuel we as a monetary authority have provided. But monetary policy is a very blunt instrument, and to use it to target something specific, even the sectors within the economy that are maybe at risk as a bubble or are underperforming, very difficult to do. So my plea would be that the fiscal authorities would put things in context of the new world we live in, which you know better than we do because you're of that generation. This is the world you grew up in. And would provide incentives for people to put people back to work using the cheap and abundant money and credit we've made possible. So that would be my answer there. There are pros as well as there are cons to this so-called innovative new technique. And the pros are pretty obvious. We've seen them in the stock market. We've seen them in the bond market. We've also seen it manifested in some of the things you talked about, Charles. I've argued the cons, I think, till I'm blue in the face. But one of the things we didn't speak about, which is it might all work once the velocity of money picks up because we have built this huge base. And then we, as a central bank, have to figure out as it goes, and if and as it goes back into the system, how we exit from the exposure that we now have. Now, again, I go back to personal experience. You can buy things on the buy side very easily. When you're on the sell side of a transaction, which is what we'd have to do to tighten the monetary policy, it's a different order, particularly when you have such concentrated ownership of a specific security, even though it's a deep and liquid market like treasuries. So I'm naturally skeptical. It's not based on anything that's precise, but the difficulty of exiting is going to be much greater than I think the theoreticians would lead us to believe. And I think that's also a con that needs to be vetted, and we do discuss this. We've had a lot of discussion at the federal, led by Chairman Bernanke, of, what are our exit policies and what are the exit principles? But in terms of actually executing against the background that Charles mentioned, when we will have a super microscope on us right now, particularly by the political forces that be, it doesn't matter if they're Republicans or Democrats, by the way. There's no difference between them as far as I can tell. They both like to spend money. And they can't anymore. So they turn to somebody else. We have to be very careful, but it really comes down to the exit tools that we use. And you can sit on this forever, or you can begin to tighten depending on how the economy responds. If we do see inflationary expectations change, we are going to have to tighten, because that also is a single mandate that we have to obey: price stability. But right now, we've had some relief on that front, and we're working towards a 6.5% number. I don't agree with it, but that's what the group has decided. So then the other question was about spreaders and too big to fail, and the idea of bail-in capital. here's the problem that I see, just to cut through all these specifics. What Sandy Weil did that was brilliant. He's a friend of mine, by the way, and incidentally, I find it wonderfully amusing that he now supports our view on too big to fail. But he realized that you could have a cheap deposit base and change the culture of banking. The culture of banking is a balance sheet culture. And what Sandy did, and what has happened, and this gets back to the whole issue of the structure and the business that people like to pursue, and why we've gone more into a different area of credit intermediation, is an income statement mentality. Now, I ran a hedge fund for years. I was driven by how much I could make every single year. And I understand that mentality. That's not the basis for know your customer, commercial banking, being a trustee of deposits. And I don't know how we go back and rebalance things, but we have taken a balance sheet culture, and that underlies all the questions that were asked, and we've infused into it an income statement mentality, so that the leaders of these institutions are driven by how much money they can make. That's what we used to call investment banks. That's what you did, and that was an honorable profession. But the blend between the two, my personal observation would be that it has diluted the balance sheet mentality and what I call the fiduciary responsibility mentality for the sake of driving greater income. It was a very good ploy. The Travelers transaction was a brilliant transaction. But I think it's driven it to excess. And I would ask Charles and Jan to give that some thought. I don't know what the answer is, but it's a different mentality than the way the system was originally structured and the way we guarantee the system. And it encourages high risk taking with the public welfare. Is that the right thing or not? It's a question that I think you can answer better than I can. I want to thank you for tolerating me. You may be a little bit young to understand this, but I know that some of us are not. I told my wife, Nancy, that I was going to be the distinguished lecturer. And I said, in your wildest dreams, we've been married 40 years. Can you imagine your husband being a distinguished lecturer in your wildest dreams at Columbia University? You know what her answer was? Richard, we've been married 40 years. You don't appear in my wildest dreams. End of story. Thank you very much.
Thank you so much. Fantastic.